Hey guys, welcome back. In today's video, we are talking about how shorts are liquidating positions, the naked shorts being exposed, how shorts are stopped, and many more in this video. Firstly, you can take a look at this. Just in, Citadel has been stopped out from multiple highly leveraged trades. A source says Citadel's in the process of liquidating or trimming crowded positions. It would appear that hedge funds are currently at their most vulnerable position ever. Now, this is in reference to this particular article. We're saying that some of the players, major players like Citadel and Millennium, are obviously forced to unwind crowded trades, and several of teams have been stopped out. So this is what we are looking at, and this is everything that we have been talking about in the past. We've always said that there has been so many short sellers, so many institutions who are extremely over leveraged, and when it comes to a point that it gets too volatile, that the risk management can no longer hold up, we will see them at the process of liquidating. And this is what's happening right now. Firstly, you have to understand that they are still using obviously the word trimming. So what we're seeing right now, it's only the beginning. It's only the start of what's to come, because we knew that the liquidation isn't going to come all at once. The regulations won't allow that. The feds won't allow that. They don't want multiple multi-billion-dollar firms to all crash at once. But what we can obviously see is the start of the burn, the start of the collapse all happening. And that's exactly what's showing right now. And we are finally seeing this. Now, it doesn't come to us at a surprise that the firms is vulnerable right now, especially with some things that has obviously been happening recently. Firstly, we've talked about the subpoenas that we've seen to Citadel, to NASDAQ, and this is what we're doing. And it's obviously talking about the failure to deliver, the settlement of shares, the naked shorting. And you can see how this is affecting them, because we just talked about how they're in the process of liquidating crowded positions. They're stopped out from multiple highly leveraged trades, and these trades are obviously consisted of these particular things that they're being called out for: the high frequency trading, the naked shorts, the FTDs, the tokens, and that involves AMC, MMTLP, GME, and of course many others as well. And obviously we've highlighted, and just to go over again, kind of the situation of everything that's obviously happening. You can see they have no choice. And when 10x or 100x of a company's share count float trades in a single session, and we can identify 5 to 8 second periods of violent HFT events that move price in 10 to 40% ranges, leaving price unchanged, we have a crime scene ripe with evidence. And when an entire float trades within an hour or even minutes, the regulators, algorithms ran by criminals, are finally forced to explain who's behind this illegal scheme. Fines are not the answers, as we did the math and discovered one firm was fined less than $4 per infraction on hundreds of thousands of bogus FTD events. And so this is what we've talked about with how they've been getting away and why they continuously done it, because it only cost them $4. For some people, this is less than potentially even their commission on a trade, but yet that's what they go away with. And remember, they've done this at the cost of $4 to make hundreds of thousands per trade, tens of millions, even billions of dollars for the firm, which at a extremely low cost. And we've obviously talked about some of the things that's been happening recently, obviously with these subpoenas. What we've seen is, of course, firstly, the court subpoenas the DTCC to investigate potential financial manipulation and naked short selling. We saw that when NASDAQ got the subpoenas, we saw them actually close down the high frequency trading services that they offer to certain clients. We also know that firms like Citadel actually have to get their positions and their records all examined and audited. And so this is the situation right now, and you can understand why we talked about they are at the most vulnerable position ever. If we take a look at obviously how this applies with AMC, you can also understand this. How many times has AMC and GME traded 20 times its share flow and spiking 200% plus on zero news and very low reported short interest, and bashing both stocks for 4 years and threatening litigation to retail? Do you need to realize that institutions are hiding something? And so we can obviously see this now. And you can see here the fact that one of the obviously keywords we have to unwind here is with they're being forced to unwind positions, and that we talked about the highly leveraged strategies. Obviously, they're going to try and cover some things behind the word highly leveraged. And one of the biggest cases is understanding that when a company has its float traded over 20 times and that exists over 20 times, 30 times, potentially even 100 times, then that's what they mean by the highly leveraged. And these may be the exact positions we're seeing them trying to obviously get out right now. Remember, they can't just get out of these positions just like that. What they can do is obviously try and sell, try and cover some of the positions, but because they've already dug a hole so deep, they can't fully get out. They can only try and minimize some areas of positions. And so this is obviously what we're looking at. You can also see here right now, as we are seeing these things happen for these firms, for these hedge funds, for these shorts, we're also seeing the price glitches again. It's just a glitch. The US stock market of fraud has more glitches than anyone can ever explain away. AMC has seen this fair share of these as well, where this is a picture of GME and you can see it spiking up all of a sudden. But what we've seen is this has been done in the past before for both AMC and GME. Now, the reason why it's obviously very important is firstly, two reasons. This normally only happens to AMC and GME. Now, you could call it a coincidence, but obviously when you pair up was what have happened with AMC and GME, what's actually kind of correlating and related to AMC and GME, you understand it's not a coincidence. What's also, and again, you can call it a coincidence, is the fact we're seeing hedge funds liquidating their positions, and we are known for the fact that Citadel obviously have been shorting GME, has shorting AMC. And so as we know that they're liquidating their positions, and we're seeing suddenly the price glitching, obviously something's happening right now. And so this is obviously what we're looking at, and this is why we obviously need to get to the bottom of it. And again, you can understand why the word invulnerable is obviously very important. And another thing you can see in terms of why they're worried, and this is just showing another way they try to get around, another way they try to suppress AMC and GME that's only coming back to bite them right now, is when shares are sold and can't be delivered or settled, they can be satisfied with the creation of an ETF allowed by the SEC. And this is what we have seen. Again, recently we talked about XRT, and we talked about how that's had over 450% of short interest. And that is a ETF used to obviously suppress AMC and GME. And we talked about the relationship between XRT being on the threshold list and AMC and GME going down. And when XRT is off the threshold list, meaning it's not being over leveraged, and we actually see AMC and GME go up. So you can obviously understand what's happening there. Now, to go more about this, you can see a fierce market sell-off fueled by President Trump's trade war and persistent inflation has forced major players like Citadel and Millennium to unwind crowded trades at alarming pace. And you have to understand, what you see is that Ken Griffin's Citadel posted a 1.7% drop in February and further losses in March. Remember, for a firm like that, a 1.7% is massive. But not only that, it's the forecast of what's yet to come in the future. And the fact it's only going to get bigger. And one thing you have to understand is that this may not be the real number that we're looking at. When we took a deep dive into Citadel's positions for the past few years, understanding that they are on borrowed money, understanding that they have been recycling their positions every single year, and that they haven't actually settled any trades, settled any positions, we know that they are not in a good area right now. And so this 1.7, it's only the forecast, it's only the start, it's only going to get bigger. And when we see the real number actually being released, that's when we're understanding just how screwed these guys are. And you can see the difference for short and for AMC, because you can see OMG, AMC at 285. Yes, I just added dollar cost averaging down big time. Thanks AMC Liquidity Fairy for more synthetic/fake shares. Because as we've seen them try to suppress AMC with these naked shorts, with these synthetics, what we're seeing is the fact they've created more shares at a cheaper price for us to buy, for them to buy back at the future at an extremely high price. And so that's exactly what's happening right now. Whilst these shorts are all worried, whilst they have to liquidate and sell their positions, the AMC investor base are only going to buy more. We are only going to use the money to buy more up. What that is going to do is cause more liquidity problem for the short sellers. It's going to put them in a situation where they think that they can finally get out. They think that by liquidating some positions, by trimming some positions, they're able to see their losses actually go away, but actually it's only going to get bigger. And they're only freeing up money to pay us in the future. But yeah, guys, thanks for watching this video. I'll catch you guys next time.